Hi, this is Barry Brooksby, co-founder of Optic Financial. Today we're going to be talking about a little secret that the Wall Street broker or typical financial planner doesn't want you to know about. We are going to be making a comparison between the S&P 500 or the market and whole life insurance, showing how good whole life insurance really is. This first chart that I have up is market history from 1992 to 2012, over the last 20 years. You'll notice here that the best of the best, the S&P 500, had an average rate of return of 9.8%. You'll also notice that there were 4 crashes starting in 2000, 2001, 2002, and 2008. These 4 crashes have an average of a 20% loss. We'll come back to these 4 crashes in a moment. Many would say this 9.8% rate of return looks pretty good, and I'd take that all day long. However, using these financial calculators, I'll show you what this 9.8% rate of return actually is. If you are an avid stock market investor or have money in the stock market through a 401k or IRA, you're probably not going to like the hole that we've discovered in this reported number. This calculator is a cash flow calculator, and it's showing us a 4.5% rate of return on an investment of $10,000. You'll notice over this 20-year time frame that the $10,000 at a 4.5% rate of return has grown right here to $24,117. This 4.5% rate of return can be achieved in a whole life insurance policy. This is an after-tax, after-fee rate of return with guarantees. This next calculator shows us an 8% rate of return as if it were representing an investment in the market, and these dollars were allocated into the market. We're going to add 3 crashes. Remember earlier I mentioned there had been 4 over the last 20 years. And we're going to show the crashes at 15%. And it actually doesn't matter where we show the crashes. We can show them in any given year, and the net result will be exactly the same. So I'm just going to put these in here randomly. And you'll notice that the average rate of return is 4.55%, but the actual rate of return is 4.19%. This $10,000 investment has yielded $22,723. If we make the comparison to the 4.5% rate of return in whole life insurance, we see that the whole life insurance returned a higher rate of return, which was the $24,117, and we had that guaranteed actual rate of return of 4.5%. Here we have 4.19%. In this example, we come back to the 9.8% S&P average. You'll notice once we actually make an invested dollar amount, the average drops to 9.49%, but the actual rate of return drops even further to 7.75%. Again, you notice these crashes: 9%, 11%, 21%, and 36%. The volatility of the market, and again the S&P is the best of the best, still only gives us an actual rate of return of 7.75%. But we take this one step further. We still have to figure taxes and fees have not been deducted from this gross actual rate of return. So if we look at the management fees, the number we're going to use is 2.5%. I personally believe it's much higher than that. And if you're in a tax bracket of 35%, you notice now that the actual rate of return has diminished to 3.69%. What if we lower the tax bracket from 35% to 30%? Let's look at the difference it makes in the actual rate of return. We move to 3.92%. What if we go to 25% tax bracket? 4.13%. Let's go a little further. What if you're in a 20% tax bracket? You now have an actual rate of return of 4.34%, which still doesn't outperform the whole life insurance policy. Let's go back then and look at this 35% tax bracket. Here we have a gross $20,658 as compared to the $24,117 that we had before. Once again, we see that the whole life insurance at 4.5% has outperformed even the S&P 500 over the last 20 years. With guarantees, accessibility to cash, and a permission slip to spend and enjoy all of your assets while you're alive, whole life insurance is a better alternative to throwing money into the stock market hoping for a high rate of return. For more information, please visit us at www.opticfinancial.com. Thank you.